You just use less money. You can start it. Spark systems, stock market systems. P is for principles. A is for application. And repeat. Once you got something good going, you got a good stock, write cover calls, selling naked puts, getting dividends, just repeat. K is knowledge. Knowledge is the know-how to apply. There's an Indian saying, if you know but do not do, you do not know. So you need to know, you need to do it. That's how you know it. So knowledge is applying everything.
I have a question.
Yeah.
When you're selling the cover call, you're getting the dividend if it's dividend time?
Yes and no. You're going to get the dividend if you have the shares at the time the dividend pays, or rather at the ex-dividend date.
Okay.
But if you get your shares called away, let's say your shares sell 315, and the dividends, well, Netflix doesn't have a dividend, but if you have Morris or any dividend stock, you have to have the shares when the ex-dividend date is assigned. If you have the shares at that time, you get the dividend. So when you do get your shares called away, you want to buy it back rather quickly because you don't want to miss the ex-dividend date. If you call your broker, ask when the ex-dividend date is. That is when you're going to get your shares. If you're in on that day, you will get your shares. You'll get your dividend.
And if you sell a put, who gets the dividend on that?
Well, normally you're selling a put, there's no dividends because you don't have the shares. If you get assigned the shares, and the shares, you kept the shares for ex-dividend date, then you'll get the dividend. But in general, only shareholders get the dividend, and the put option is an option, and there's no dividend attached to it. Only the shareholders who have the shares get the dividend. So you don't.
Okay.
On the cover call, you do as long as you have the shares when the dividend date is announced.
But on a covered put or a cash put, then.
Well, you have to ask your broker what they mean by covered put, because if you have 100 shares of the stock, then you have the shares. In that case, you'll get the dividend.
Okay.
And you're pretty safe, as far as the trade, because if the stock goes down, you'll have your shares down there. You won't have a margin call. You don't know how much you're losing. Okay, so the systems. One, we have share growth. Make money when stock goes up. Share growth. So you buy Netflix at 300, goes to 330. What percent is that? 10%. 10% growth. 30 points of 100 shares. How much is that?
30 points of 100 shares?
3,000?
Yeah, 2,000 bucks.
100 times 30 goes 3,000. Share growth. If you're a trader, you can trade it, say, hey, let's make some money on a trade it. If you're a long-term investor, you just look at it and just be happy. That's share growth. Number 2, dividends. We just did Philip Morris MO. They pay 4.64% dividend per year. Right? I call dividends like getting paid while you sleep. Just hold it and they'll go to your account. Some stocks, they kind of go down over time, and these ones are to be avoided. dividends. What Phil Morris will do, if you look at the 10-year chart, it's pretty good. Goes up. This maintains. So you always want to be the stock that maintains. Sometimes they're paying so much dividend that all the cash is going out into the rest of the shares of the stock will go down. And you don't want that. You don't want your dividend stock to be going down. You can be paid 10% dividend or more. As your shares are going down, you lose your share growth. So you don't want that. You want this. Your stock, your chart, 5-year, 10-year, and 2-year to go up. And you're getting share growth and your dividend just like MO, Philip Morris. A lot of lawsuits, they still pound profits year after year. So, Budweiser is a good one. I like that one, Budweiser.
Costco's been a good dividend.
Costco pays just over 1%. It's not great, but it's decent.
But I mean, they give that special dividend, I mean, that really.
Oh, tell me about the special dividend at Costco.
Every once in a while, I think 2 times in the last 5 years, they gave out 2 of those. And they were like 7, I want to say, I could look it up.
Don't look it up, don't look it up.
I want to say like $7 a share one
So you get an
time.
extra dividend on top of whatever they pay normally.
Plus the regular.
It's a nice bonus. Okay, 3 is cover calls. We talked about cover calls, we talked about cash cow. So you're gonna buy the shares, you write the cover call, a little bit higher so you get share growth. The premium's gonna be anywhere between 2, you're looking between 2 and 4% a month. You write monthly, and you're doing good after a year. Try to maintain the stock, try to maintain the shares. If they sell, buy it back and write the cover call. Here's something I didn't tell you before. If you're in Netflix at 300, and you write the 315, we're gonna get 1250, right? Here's the thing. What could happen is the stock can go up to 330. Okay? You have to buy back at 330. You're still gonna get about 1250, okay? Right? Now what's gonna happen? What can happen is the stock can go down now to 300. All right? Your buy point is 300, and the stock has gone down to your buy point is 330. The stock's gone down to 300, so you're at a 30-point loss in the share growth. Okay? And you can make this up over the months. Well, what I want you to do is if you buy it at 330, it goes down to 300, which happened if you got it last week. I still want you to write the cover call for 315 again. You're gonna have a loss of share growth at 15 points because you're gonna resell at 15. But I'd rather have 1250 a month, knowing I can catch up on any share growth loss over the months, than not write the cover call and waste time and get no premium. You can also write the 330, you can get about $7 or $5, right? But I want to advise you to write even the lower strike to get the premium that you want, even if you're going to take a loss of share growth, because it's not going to go down every month like this. It's going to have to, if it's a good stock, it will maintain and go up.
So it'll take like 2.5 months to recover then?
Exactly. But just just plan on the next 10 months of writing cover calls. So if you're getting 1250, just plan on having 125 points income or 12,500 income for the first year in your $300 stock. And that'll help you maintain when it dips. And like I said, you want to be buying when it dips, not selling. And that's the idea. You can always exit the market, but then when you get back in, that's the thing. Any questions on cover call?
Best time to buy them on the dips? Always?
Yes and no. But the best time to buy is any time, because you want to get in, period. Some people wait for the dip, it never happens. And it goes up and never get in. I rather in that case, just buy in. Because it's better to have a position than not.
And
You're
Okay,
not going to be able to pick the exact dip or the exact peak.
and what's your best time to buy it? Like how many days out?
So I'm gonna do,
Like when you buy your cover calls, you buy it 30 days, 40 days, 35 days.
we write the cover call, 30, I think 30 days. Between 3 to 5 weeks is great. And I like to trade the monthlies. Cover call monthlies,
But I mean, do you ever, so the shorter,
not weeklies. Weeklies,
so the less days though, it's the faster time decay, right?
yes. But you, when you're selling options, you want time decay. Works in your favor. But when you're buying options, you want to go farther out. When you sell an option, when you sell, right, or sell, go 1 month. Okay? Or less, but 1 month in general. And if you buy options, if you buy an option, which is very risky by the way, you want to go 3 to 6 months out. And sometimes you want to do the leap, 1 year leap. Because you have longer for your position to perform to make money. These people are novices and they're getting their accounts and they're buying options for like next Friday. And then the earnings come out and it goes to zero and the whole position's gone. But don't do that.
Who's the buyer on the other end of these?
The seller.
When you're writing, let's say
Or the buyer.
you're selling,
When you write a cover call,
yes.
anybody who wants to buy a call in Netflix, a call option, is that's who pays you the money.
Yeah, I know.
And there's plenty of those.
Who are those people though?
Most of them are people like you and me, or they could be big traders. But there's always a market for calls and puts. There's always a market for buying and selling. So when you sell at the market price. If I get these tomatoes, I can sell them at the market price as a trader. So the market price might be 89 cents. So I just sell 89 cents. When I buy, I go to the store, it might be a little higher to buy them. I might pay 90 cents to buy them. Everything, there's a market for everything. So no matter what you have, when you have a stock, when you buy it, there's a market, there's a price for it. And that's on your phone or on the computer. And when you sell, there's a price for it. That's the bid ask. Bid, ask. Ask is when you buy, bid is when you sell. So there generally is a spread. For Netflix, the spread might be 30 cents. So in a share, if you buy for 300, when you sell it's only $2.99 and 70 cents. You're only getting that because Wall Street makes that difference. That's the specialist commission. That's the spread. So you do lose money trading. That's why you don't want to trade so much, because you have to pay that just to beat the spread. It takes effort. And then you have a commission, $8 for TD Ameritrade, right? Some places are more. Robinhood's less. I don't like to do Robinhood because you have to wait in line just to get an option chain. There's no broker to discuss your account. There's no check writing. There's no free wires. No 24-hour customer service. If the stock goes down, we can always call TD, but there's no calling your broker when the stock goes down the Robinhood. Okay, so there's always a market. There's always someone willing to buy and sell. And when I discuss those prices, like this, the sells and the buys, you can look at any stock. And on the new TD app, they have the island prices, which is, it tells you, this is Amazon, it tells you who's buying, how many shares, and who's selling. That orders are sitting here waiting to click. They get, when the price moves, it clicks. 1485, 200. Give me a number over here, Chris.
500.
500. So somebody wants to buy 500 shares when it hits 1485. 100, 2,000. Someone wants to sell 200 shares when it's 1485. So these orders are just matched up. They're just matching up. The specialists in the computer is matching up the orders. And they execute. There's thousands of them. And they click like this, like clockwork. And then if there's more buys, then the price shoots up. Because look, if this hits 200 shares sell, it moves the price down. See? And it keeps going down. If all these cells are wiped out, the price somebody sold all their shares. If you have 1,000 shares with Amazon, and they're selling, there's limit orders here to sell. 14.95, 14.90. There might be 500 here and 500 here. So now, Arden, you want to sell 1,000 shares of Amazon. You want to cash out and go to Jamaica. There's only one buy order for 14.95. There's one for 14.90. So you're going to have to sell 500 here, and it lowers the price to 14.90. You sell 500 here. So now the price is 14.90. Okay? And what happens? 14.90. Hey, I'm buying 1,000 shares. That moves it up to 14.95. See that? It moves like that. So we covered cover calls. We covered share growth. We covered dividends. How about stock splits? Stock splits. Stock splits are important. If you look at there's a website, it's called Stock Split History. By the way, nothing on Google or Yahoo or in the internet is really professional advice or professional information. The way you need to get the real information is to call your broker, because they're hooked right to Wall Street. They can tell you the dividend, they can tell you the stock split, what it was. When you go on Google or Yahoo, they have these college interns putting this information out, Wikipedia and stuff, and a lot of times they make errors. So you never trust the exact thing that's on Google or StockSplitHistory.com, because there's a lot of mistakes. If you need to be exact, just call your broker, and they'll tell you the stock splits, they'll tell you the dividend price, they'll tell you what's the bid and ask. Okay, that's important. People think that they Google something, Yahoo something, oh, this is for sure true. No, it's not. You might not even have a dividend on Yahoo showing when there's a real dividend. Like this stock, EMD. I'll add this one to the dividend. It's about $14.20. This stock pays 10 cents a share dividend per month. They pay monthly. So it's better than quarterly, because you don't have to wait 3 months, you get paid every month. And it's paid 8% a year return. So this is one of the best dividend stocks you can get. And it pays monthly. And it ends up being 10 cents a share.